Welcome back to Golden Rule Radio, your weekly recap of the precious metals market, and it's an exciting week to give a recap on, is it not, Miles? A lot of price activity, not that we've been short on activity since basically September of 2022, but what a volatile week.
It has. You know, Rob and I have spent the last couple weeks talking a little bit of theory and philosophy, theory crafting about markets. So welcome back, Tori. Glad to have you back in the studio. But man, you're dead right, I think, with the volatility in the market, some changes in the ratios we want to talk about, and a U.S. House of Representatives congressional testimony by the Fed this week that I want to dig into a little bit. So a lot of ground to cover and some specific numbers to take a look at, so I think we just dive right in.
Sounds good to me. Let's start with gold, and then we will transition over into that ratio. That's been a key point.
So one of the things Rob and I talked about was gold in the futures market breaking into all-time highs about, 2 weeks ago, hitting up to about 2085, I think, on the futures market price. We have had a retracement back in gold. I've been watching this ending channel here, and as everybody knows, I tend to get a little tentative when I see some trading action nearing highs, and I'm always looking for those pullbacks. So if we take a look at the chart here, you can see since about the end of March, after having this phenomenal growth period dating back to November of last year, slight correction at the beginning of the year, but then a big jump starting in March. We've had some bouncing highs channeling upwards. You can look at the bottom of my chart here. You've got declining relative strength index, meaning that although the highs are getting higher, they're getting higher with a little less fervor than the previous one. And we built this great trading channel, which here in the last couple days we have just broken below. So we had been calling for some semblance of a pullback. It's just too much strength in a short period of time. You've got to release a little bit of air from the system, let the market take a breath. So what are some of the levels we could be looking at here if we continue this pullback since we've broken down through? So if you're looking in the short term, and you and I were talking about this yesterday, because there's kind of two markets in gold you can look at here. You can look at what's happened since March, so just the last couple of months, this last leg up. And you can go back, stretch it all the way back to November, what's happened during this entire leg up. So in the short term, I would argue our first real stopping point is really not too far away. Your short-term 382 fib is about 1970-ish, give or take a buck. I got 1969, depending on if I drew my charts right or not. Below that, 1939, and then down at around 1909. So I think we're looking at some short-term levels here where you could see gold correct back down. I really like 1909 because it lines up with a rising channel that takes us all the way back to the November low and where we kicked off this phase of the bull market. So let's stretch this out a little bit. And if we look at some of the retracement levels starting back with November now, your first 382 fib, I've got targeted right around 1899, 1900, which is real close to 1909 on the short term.
And you love it when those numbers start to line up.
I do. I love it when you've got, say, fib levels in different time frames lining up with, in this case, the bottom end of a trading channel on the way up. The other thing, too, is as of today, we've now touched the 50-day moving average. The 200-day moving average is sitting down around 1820, so that's starting to come up as well. So maybe we get that low. By the time we get there, maybe you're looking at gold slightly under 1900. But realistically, that doesn't necessarily have to happen either.
I'm really glad you brought up that moving average. We don't often do that, but that is a key fundamental, especially in the short term, is it not? Because if you get a significant detachment from that, certainly 50-day moving average, chances are the odds are pretty solid that you're going to see the 50-day moving average touched or at least approached, and that's exactly what has happened yesterday.
Oh, definitely. I mean, there are traders out there who focus exclusively on, say, Bollinger Bands, which are looking at divisions from means. And the reason why I like indicators and the reason why I like looking at multiple indicators crossing at a specific period of time is because there are investors and traders out there in any market who tend to hyperfixate on one or two indicators. And if you take all of those people plus all of the people that like this other indicator, plus all of these people, plus all of these people, and you kind of lump them all together, where are they going to all make the same decision at the same time? So that's why I like looking at moving averages plus Bollinger Bands plus RSI plus MACD plus Fibonacci levels. If you can find a place where 3, 4, 5, 6 things are all happening at the same time, there's a good chance all of those people are going to play ball at the same time.
Yeah, there are some that even look at shorter term, 15-day or 65-day moving averages, right? Where something is either overbought or oversold. So one of the theories is that gold got a little overbought, right? Silver got a little overbought. We've seen a 5% decline in the gold price. We'll compare that to a 10% decline in the silver price in the same period of time. And silver, what had been holding very strongly, has now shown a little bit more weakness. And in that period of time, we've seen the ratio go, just a few weeks ago when you and I were recording, the ratio had gotten down to 78-1. Now the gold to silver ratio is right back up to 83. That 5 percentage point differential between the two metals resulted in a 5 percentage point change in the ratio. So jumping into silver, any significant numbers that you're seeing us approach there?
Well, I think it's important to remember that silver had a pretty significant breakout to the upside back in March when we broke above a declining ceiling trading channel. Not unreasonable that silver did get up to the 2022 highs, almost got to the 2022 high, broke into that range. So you're right, we're seeing a little bit of a pullback there. It was a significant move up. I mean, we're talking from 20 to 26 in like 2 months on silver. Percentage-wise, it has to take a breather. So we're back down to the short-term 382 fib. This would be just in the most recent move from March until here, beginning of May, end of April. And we're at that 382 fib about 23 3/4. The next number down, and this is where the fibs start lining up. Oh, and since you mentioned it, silver actually also touched the 50-day moving average here in the last week.
Love it.
So your next movement down is where you start to see the start of the move up back in November again, when the metals started coming up again. Compare those corrective levels to, say, the short term since March, just over 23, maybe 23.05, 23.10. You've got some fibs lining up. 22.25, you've got some fibs lining up. And then you've got a rising bottom channel and the 200-day moving average all kind of lining up there. So again, if I wanted to take multiple indicators all at the same time and say where would be a really good entry point for silver if it continues down, 22.25 is probably my target.
Oh, that's great information. The September and October lows that we put in now with a little bit of retrospection could be determined to be a false breakdown of a bull market. So we had been in a bull market really since COVID, and we started to see this nice steady climb interrupted by the interest rate hikes and the Federal Reserve central bank monetary policy and interest rate policy and their tightening of their balance sheet and all that. Now we're starting to see that get exhausted as well. So one, we've proven that those lows in the fall were a false breakdown. Could this also be proving just to be merely that, a healthy retracement in an otherwise bullish trend, right? Jury's out.
Right.
We lean that way. So we're going to buy dips. You talk about being oversold. We're going to get into an oversold position here when the underlying fundamentals haven't changed. So again, we talk about all the technical analysis. What's under all of this? What's under all the market, right? So certainly geopolitically and all that, but debt. We've got this huge debt discussion. We've got the banking situation, which you want to get into here in a bit too with the congressional hearings. But just the debt ceiling. We've got this debt ceiling discussion going on in Washington. They're going to raise the debt ceiling. We know there's political gamesmanship going on, but they're going to raise it. The debt will continue to increase in perpetuity, it appears. All right. Not good for the U.S. dollar, but good for the gold spot price over time because it just maintains purchasing power. Same thing with the household debt. Unfortunately, what they are being successful in doing intentionally is slowing the economy, cooling the economy, driving unemployment higher. Those are all things that don't bode well, obviously, economically, but they also mean that the Fed will likely overshoot and have to pivot. That's when I see the dollar index, which has rallied a little bit, 103. That's not a huge rally, but certainly coinciding with what we're seeing with the gold downturn. But that dollar resumes its decline, I think, if and when the Fed has to pivot and either pause the rate hikes, increase the balance sheet, or certainly have to start quantitative easing again to stimulate for any number of economic reasons.
Sure. I mean, the dollar is effectively flatlined over the last 30, 60 days. Now, it has bounced up a little bit. It's back up just under 103 at time of recording, and it touched its 50-day moving average.
The dollar also touched its 50-day moving? Wow.
Yeah. I guess everything touches its 50-day moving average today. Wait, hang on. Let me look at the Dow just to make sure. No, the Dow touched its 50-day moving average too.
Really? Okay.
Everything touched its 50-day moving average today. I guess this is the back to mean day. Oh, what happens next?
I don't know.
Talk about drawing the bowstring back. So anyway, getting back to the dollar. Sorry about the tangent, everybody. Getting back to the dollar. Yeah, the dollar is flatlined. The dollar popped up a little bit today. That's fine. It has been down for a while. I don't know where the dollar's going from here.
Well, you've been thinking a 105 to 106 range for a while that we have failed to reach. Maybe this is going to be your opportunity because we also have the summer lows coming around the corner. We tend to see some seasonal bias where the precious metals take a little bit of a breather in June, sometimes into July. So certainly that could coincide with the dollar rally, especially if they pause hikes and they decide in June to just keep it where it is and see what the economy is looking like and see what the credit markets are looking like before they go to raise again. So that could certainly rally the dollar.
So let's talk about if they're going to pause hikes and what the credit market's looking like. I know I'm a crazy person. Please don't try this at home. I actually downloaded the PDF today from the congressional hearing, and I read through a fair bit of it today, specifically the banking system conditions section, which may be worth your time. Don't go do it, but if you're bored out of your mind, it may be worth the time. So there were a couple key things I wanted to point out here that they went through. The big areas of concern are commercial and industrial lending, consumer lending, and then unsecured stock and bond portfolios. Big surprise, right? What was the whole SVB issue?
Exactly.
Right. But I think what's getting, because the SVB issue was such a big deal that caught a lot of people off guard, I don't want to gloss over the concept of commercial and industrial lending and consumer lending, because there's a couple things here. I love this quote here right out of the paper. Robust. That's a pretty optimistic word to start a sentence off on. Let's hear how it finishes. Robust consumer spending continues to drive growth in credit card loan balances, pushing overall consumer loan balances higher. I would have used a different word than robust, because that's pretty optimistic.
Maybe irresponsible?
Right.
Who knows? But that ties into household debt hitting a record $17 trillion last quarter. And credit card debt, which usually in the first quarter is not too bad. U.S. credit card debt is nearing its all-time record in the first quarter.
Right. And loan balances, same thing on commercial and industrial. Loan balances continue to grow on the commercial and industrial side. And there's a genuine concern over commercial real estate right now. They talked a lot today about commercial real estate, especially office buildings. I think in the post-COVID era, you've got some white-collar jobs that may not be as important as they used to be. And there are a lot of white-collar employees that have discovered that working from home kind of works for some companies. So there may be a concern for office space being available and the price valuations of office space for the banks that actually own the space that are getting paid out on. Another interesting point they brought up, deposits have declined at banks. Now, we did hit an all-time high of around $18 trillion last year in April of 2022. That's come down about $1 trillion. So deposits are starting to whittle down. Savings accounts are getting used to pay off these increased loan obligations that the consumer side is seeing that we just mentioned.
So are retirement accounts that you and I can speak to. IRAs are being tapped into.
And then of those rates, they're acknowledging that delinquency is 30 days past due or worse, and then non-performing, of course, is 90 days past due or worse. Both of those rates are starting to rise. What I noticed in a chart they added is, when else they were both starting to rise? 2006 and 2007. you started to see delinquency in non-performing loan categories as a bank asset beginning to rise, leading into the stock market crash.
We're hearing about it already in the automotive loan sector.
And I mentioned it with the commercial lending, especially office properties, 1.8% in fourth quarter of 2022 were delinquent, that the 10-year average is 0.7. So commercial real estate is a massive problem that nobody's talking about yet for bank balance sheets. And it was brought up continually today during the congressional hearing. And then finally, in the other category, so we talked about lending, the other category of unsecured security positions. That it continues to be the big concern that everybody's talking about, because one of the biggest problems is the way they mark the valuation of the securities. Just like anybody else, you haven't taken a loss till you sell it. And your fair value of most of these securities, I think the number he gave was some estimated $277 billion below their amortized value cost, compared to $224 billion negative last year. So everybody's at a loss in their stock positions. Well, guess what banks don't want to do? They don't want to realize those losses.
Right.
So they're not liquidating at a loss their stock positions, but they need the liquidity to cover the problems on the lending side. So what are they doing? Well, we just mentioned that. They're taking money out of their cash holdings to secure loans. So they're burning the furniture to heat the house because they refuse to sell the security positions that are at a loss to do so. Now, in a closing remark on this section, and I'm going to read this as a quote because I think this is brilliant, there is an alternative solution to getting rid of your savings account. So banks are doing the same thing you and I would do. They're dipping into their savings because they don't want to sell their stocks at a loss, but they have to pay the credit card bill. So the banks are doing the exact same thing you and I would do on a personal level, and he went through the whole stinking thing today explaining the process.
And here's the caveat too, is that can continue unless they start losing deposits.
Yes.
And if depositors start
and that
fleeing,
was the SVB thing.
That was it, right? Because if somebody can seek yield somewhere else, it doesn't even have to be that they're concerned about their bank failing. It's that they're concerned about the fact their bank's not giving them any return on their deposit when they can take that money out, go buy treasuries, even in the short term, or treasury money market, and get a 3 to 5% return on their dollar.
Yep.
Now the bank has a problem. And this story is to be continued.
So guess what a bank can do that you and I can't? So this is straight out of the paper from today. As an alternative to selling securities, firms can access other contingent sources of funding, including the discount window and the new Bank Term Funding Program, by pledging eligible securities. The Federal Reserve Bank is here to save the banks.
Wow. But don't expect them to save you. What do you and I have to do? We have to put ourselves on the gold standard. You have to be able to have a hedge on your portfolio. Your investment portfolio has to be adequately prepared and protected. And that's preservation of purchasing power. And they're not going to put us on a gold standard. And we don't have somebody coming to us, giving us money, pledging our securities. No way are we going to be allowed that type of a risk. So in the meantime, you determine the percentage of your portfolio that needs to be in tangible physical metals. You stick to the plan. You buy gold in this type of an environment at regular intervals, consistently and always, maintaining that percentage no matter what's happening to the rest of your portfolio, and you can sleep easily at night.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you'd like to discuss your personal portfolio and ways to protect it, since Janet Yellen probably isn't going to write you a check, how about you give Tori, myself, or someone else here at McIlvaney Precious Metals a call? We can be reached at 800-525-9556. Our website's at McIlvaney.com. We can be found on Twitter at ICA Gold or Facebook, McIlvaney Financial. Thanks for listening and have a great week.